Hi, and welcome to the Coronavirus Freight Market Update for May
everybody.
21st, 2020. My name is Kevin Hill, here as always with Michael Vincent in our interactive show that we do every Tuesday and Thursday.
Yeah, twice weekly, interactive. So hit us up with questions, comments on FreightWaves LinkedIn and on Facebook. We'll be happy to answer those questions or get somebody to answer them for you.
And we have a fantastic show today,
We do.
so
Who do we
please
got?
comment. We have our news headlines coming up first with Andrew Cox, research analyst here, and then we have our Director of Freight Market Intelligence, Zach Strickland, coming in to talk about the freight markets, and our lead economist, Anthony Smith, to talk about job numbers, economic indicators. And then
Excellent.
from outside, we have Marilyn Surber from Tenstreet. Going to talk about driver recruiting, driver hiring, the schools coming back online, and then our very own journalist Alan Adler coming up at 12:40 to talk about Class 8 truck orders and what's in store for that.
Yeah.
It's pretty negative news on that front.
Yeah, it's going to be a good show. Lots of good information, lots of good guests on today, and very important topics.
Very
obviously.
important topics,
So
and another important topic is the numbers.
Right
So
on.
let's do the numbers.
Let's do the numbers. So on Tuesday, May 19th, the U.S. coronavirus case count was at 1,552,140. Today, right now, we're sitting at 1,595,318. So roughly 3,000, actually, a little bit higher than that, 43,000 increase. So, and deaths were at 92,021, and now they're at 95,021. So about a 3,000, exactly a 3,000 increase right there. When we started this March 17th, we were at 6,300 cases and 110 deaths. Curves are flattening, though, still, and coming down a little bit, which is definitely good news. So, let's move on to news, yeah? Shall we?
Let's move on to news, and Andrew Cox with the headlines, and we're going to start it off with some layoffs at Samsara.
That's right, Kevin. The ELD and fleet management solutions provider Samsara announced yesterday that they would be laying off 18% of their workforce, about 300 employees. The CEO said in a blog post that it's now clear that COVID-19 has become the most significant economic event in the past 100 years, and since the outbreak, they've had to play out scenarios that they thought were unimaginable just a couple months ago. The employees laid off will receive severance pay and also will receive their health care benefits through the end of the year. And these layoffs come at a time just 2 months after competitor Keep Trucking had laid off exactly 18% of its workforce. So a little bit of a coincidence there with Samsara. But the focus of these layoffs were on geographic areas in Europe, like Spain, Italy, and Benelux. These were areas that had a long road to profitability, so they went ahead and shed them. They said they're going to continue investing in Europe, but looking at other options while in the continent. And this is, it comes at a time when Samsara just tripled their cash budget, their cash position by getting $400 million in new equity financing. So you have to think that there were probably some strings attached to that equity financing, and that's why they had to go forward with these layoffs.
You're right, Andrew. It seems like an odd time when you raise $400 million, but there are oftentimes strings attached with performance and markets and employment to raise that cash.
Some markets that were definitely in trouble, the Benelux and Spain and Italy, and now focusing more on Germany, Austria, Switzerland areas where they're really focusing, and they also cut back, I think, in events and recruiting as well, Andrew. So, a little right sizing, I think.
A little right sizing. Next on FreightWaves.com is airline and getting airline passengers back in. It's a metric that both Andrew and I follow very closely, year over year airline passengers. What do we have on that, Andrew?
Yeah, Kevin, Memorial Day is quickly approaching. Holidays are typically a big travel day for the airlines this year. It's likely going to be very depressed. So airlines are doing their best to recapture some of that lost business by emphasizing extensive hygiene protocols and practices designed to try to make everybody feel safe while on the planes. There's kind of a renewed hope that there's some pent-up demand on the airline side. As you know, Kevin, we've been looking at this data. The TSA is only pushing through about 9% of the typical passengers right now, so very depressed. And the airlines just know they have to do as much as they can to try to ease the minds and the fears of passengers, because passengers see airlines and airports as really infestation points, so they're afraid of getting in there. So they're doing their best to make sure everybody's safe.
They definitely need to up the communication game to bring airline passengers back on board.
They do, and I mean it's going to be a difficult road to hoe there, right? I mean, because the in-plane air filtration systems and stuff like that, they're going to have to upgrade that, I would think.
I would think so too, as well. And during their earnings, American, Delta, United, all pretty well, Southwest as well, all were pretty well in line with 2 to 3 year recovery to get up to that 2.5 million a day passenger total that we saw certainly in 2019, and right now I think it's at 200,000. It's kind of doubled since the lows in April, but still at 200,000, you're at still less than 10% of the passenger totals
somewhere in
each day right now.
Yeah, like 9%, right?
9%
is where they're at. And Andrew, did you touch on? I mean, it's the industry wants to see this happen as well, right?
Well, of course, the transportation industry wants to see this happen. We've seen a lot of supply chain shortages even for air cargo, because 60% of the capacity for air cargo comes on the belly of passenger planes. And when all the passenger planes were canceled, that takes a lot of the capacity off the market for expedited and air travel and air cargo. So yes, of course, the supply chain industry, the transportation industry is also hoping that they can get some planes off the ground and get people in them so that there is available capacity to them.
Yeah, not even, I mean, just the capacity. So the supply chain cycle slows down. You've got less capacity. Price goes up. Price of manufacturing. I mean, it goes on down the line. So there's, whether you think about, I'm not going to be traveling that much anymore for work and stuff like that, and I'll travel just a little bit less. You got to think about how it affects everybody.
It certainly does. It certainly does.
That's one thing that this has brought to the forefront is that supply chain. We're all involved in the supply chain, no matter who you are.
And you can learn more about this article on FreightWaves.com. Eric Kulish wrote this, and you see that on the front page there. Our next story is Celadon struggles again. They had a deal for their Mexico portion. That fell through in April. What are the updates on that, Andrew?
Yeah, that's right, Kevin. The PAM deal, PAM Transport, was supposed to buy their Mexico operations for $7 million back in April. That has fallen through. Celadon has now asked the court to allow them to pursue a public auction of its Mexican business with a deadline set for June 8th. Celadon they've been in talks with White Willow Holdings to sell the Mexico business now for only $2.4 million. You can see that price tag has been drastically reduced, and there are some players here in this selling that is not looking to sell that business for $2.4 million. Huntington Bank, based in Cincinnati, actually is owed over $3 million by Celadon, so they are holding up the process here to ensure that they receive their money.
Yeah, I guess there's some creditors that aren't too excited about a 65.7% drop in the price tag there from $7 million to $2.4, right?
Yeah, that's exactly right. And White Willow Holdings has been in the news recently, at least. They've also looked at buying some of the Comcar assets. They're into buying distressed assets. So we'll have to keep updating this and see if they end up going through with the deal. It will be a battle between the creditors as well.
It definitely will. And you can find that story again on FreightWaves.com. Noe Mahoney authored that story. How about a sneak peek to the DHL Supply Chain Pricing Power Index, Andrew? That will be coming out later today.
Sure, it'll be out this afternoon. I'm not sure exactly where the number is going to be, but I do believe the carriers have gained a little bit of power over this week. It's good for everybody that volumes are surging. It's really not constructive for either side on the pricing negotiation for volumes to be where they were in April, so it's good for both sides for coming up. And we're starting to finally see some pressure upwards on rejection rates across the country. Again, they remain really loose. Capacity remains really loose, but I do think the carriers are finally coming off the bottom here.
Thank you very much, Andrew. Any other headlines that you can think of?
Not off the top of my head, but again, just keep looking out for Seth Holmes' article coming out tomorrow on when we're doing some correlations between outbound tender volume index and the Bank of America consumer spending data.
Hey, Andrew, I wanted to go back to the air freight just for a second. So we're at 9% capacity right now, or being utilized in passenger, right? With air freight, I say air freight, but I mean the airlines, the passenger airlines, right? And that is 60%, right? Or it was 60% of the air cargo capacity.
Correct. Yeah.
Right, was the belly capacity that was on those. So we're at 9%. So has that been growing, or is that an old number, or is there positive signs there? Do you have any insight into that?
Yeah, I do. As Kevin mentioned earlier, the passenger number has doubled in the past 2 weeks. It's come off the bottom quite significantly. If you break down the x-axis to just a couple months, you can see that there's a significant move upwards. But if you stretch it out to maybe a year long, there's no noticeable difference. But yes, it has come up off the bottom a little bit, but again, remains extremely low.
It'll be interesting to see how the summer pans out because, you had Mother's Day last week or a couple weeks ago, and then you have Memorial Day, which is a heavy travel day.
Yeah.
So you expect those increases, and it has, as we said, it's doubled. It was less than 100,000 for a few days in mid-April. So it'd be very interesting to see coming into the summer where it kind of levels out at, and if it grows at all because of states opening up and maybe people will start flying a little bit again soon. Yeah,
absolutely. And one of the other things, and Andrew, you can chime in here too as well. It's just kind of out there for both you guys. But you look at the air cargo capacity, right? That is on the passengers. 60% of the capacity is down. A lot of industry experts and CEOs of these airlines, they're looking at 3 years for recovery to hit 219. Right, as far as capacity levels or their business, the passenger business.
Return to normal.
Which obviously directly correlates to the capacity. And then now, Andrew, you're talking about the DHL supply or the DHL pricing index, right? Ticks up. We expect it to be ticking up. That'll come out later today. The auto manufacturing we talked about before is trying to come online. We talked about last show, trying to align with Mexico, et cetera. These different things. Is the recovery, in your opinion, are we riding a brief uptick that's going to kind of stagger down a little bit and go up, or is it just going to be a slow swoosh, or what are your kind of feelings with all those kind of things in mind? What are your thoughts on that, Andrew?
Well, I think there's a lot of pent-up demand right now. I think you've had housebound Americans sitting in their homes for the last couple months that have really been dying to go outside and go to restaurants, and that's visible in the Bank of America spending data. Restaurant spending is now only down about 30% year over year. So I think there's a lot of pent-up demand that's going to give us a quick little shot of recovery, but all of this is still hinged on the idea of getting a vaccine, and which will likely come months later down the road. I mean, if there's another outbreak, this could shoot us right in the foot with this recovery. So I'm not willing to wave the flag that this is a full-bound recovery and that everything's going to be rosy, but I am saying that this is some good news. We were in a bad spot for many weeks, and this is now any good news is positive right now.
I have to agree with that. Any good news is positive. I was just wondering your take on that, because everybody's trying to get a handle on this and what kind of indicators to look at. And we all want it to happen, but then reality sinks in. You got to think about all these different things. Yeah. And there's plenty of people that are hurting and being upheld by stimulus packages and extensions on loans, et cetera, that are going to falter anyways, even during the recovery.
Exactly right. Thank you very much, Andrew Cox, for the headlines. You can catch all these stories and much, much more on FreightWaves.com. And going back to the recovery, Michael Vincent, we had Lawrence Alvarado on last Thursday, I believe, and he was talking about W's. A lot of the recovery is going to be a lot of a string of W's, and I'm buying into that philosophy more and more. Very localized W type of recoveries, and then downturns as we come out of this basically economic lockdown.
Yeah, I mean, when you think about it, even though we're on this, we're definitely on some sort of upside, right? Businesses are coming back online. Like he just mentioned, I didn't realize that restaurant spending is only 30% down below last year. That's a huge number, but it's only because it was zero or.
It was about 50%, so it's recovered. Right. A lot of these verticals really have.
Bad. But we haven't. Have we seen, or do you think there's a wave, or because that feels like there still is of businesses just tanking even during this recovery because of they're being strung along right now and helped with the PPE, et cetera, or PPP, et cetera. Is that just stringing along or delaying the inevitable?
It could be, and that's one of the questions that's definitely out there. You know what else has recovered, Michael Vincent?
What's that?
Freight volumes. And Zach Strickland, our Director of Freight Market Intelligence, is in the house right now.
Much to Zach's chagrin, they're up.
I know, right? What do we have, Zach?
Yeah, so freight volumes continue their rise. Now, something that's a little bit, we have to take into account is the fact that we are about to enter the Memorial Day holiday weekend a little early this year. It's right around the corner. It may not feel that way for a lot of people working from home right now. It doesn't necessarily feel the same as we ramp into the holiday weekend, but again, we're in uncertain times. Normal patterns don't apply to this scenario that we're looking at right now, but the outbound tender volume index jumped up over 10,200 for the first time since early April, when it was falling down off of its near record volume levels in late March. So, something that came along with that, however, is normally when we see these volumes increase right before the holiday, you have to keep in mind a lot of these load tenders that we're measuring have a forward-looking aspect to them, and the way that they are sent out in advance of when they're supposed to be moved. Their requested pickup dates normally are at least 2.5 to 3 days into the future when we get them on average. So we normally see these lead times, as we call them, which is the time period between requested pickup date and the submission, spike right in front of this, and by as much as almost a day on average, just because a lot of these people are trying to get out of the office. They're trying to move this freight, make sure that it's sitting out there ready to go the week after, because they're going to have this long weekend, take some time off, potentially take vacations. That is not happening with this, with this holiday. So lead times hovering right around 2.6 days. Last year, you're looking at something around 3.5 days for lead times as we were approaching the Memorial Day holiday. So these volumes are a little bit different than what we would normally expect to see during the holiday period.
Yeah, Zach, that's really interesting. I was watching you this morning, and I had noticed that as well, looking at SONAR this morning, is that what is going on here, right? Because like you said, right before a holiday, you see volumes, and we certainly do before Memorial Day, except last year we had that anomalous dip right in this area. Trade wars, tweets, whatever it was. But it's normally up, and tender lead times go up as people are saying, hey, they're trying to book their freight for next week, right? The movement's for next week. And so that rises because your tender lead time, or when they assign it to a carrier to the pickup date, lengthens, as you explained. That's not happening. Does this bode well for freight movement next week?
Yeah, I don't know if it does. Honestly, right. This feels like, again, a lot of the volumes that are moving right now, or that are being submitted to move here in the future, are coming out of the West Coast, Los Angeles, Ontario, again, DC heavy area, a lot of port activity, and we've of course seen that port volume drop off significantly here over the last few weeks after peaking in late April. So this feels a little bit tenuous. I'm not necessarily optimistic that that's going to be sustained throughout June. Normally, we do see volumes increase throughout the month of June, seasonally speaking. I'm not sure if this is some sort of pull forward or not. I mean, obviously, we'll see. Later in the week, next week, whether or not this is going to have some sort of sustainability or not. As we close out the month of May, last year about this time, we actually saw volumes really surge up in the first week of June. Again, about 4 to 5% week over week during that week. So it's going to be it's an interesting scenario to see play out. I don't know if I'm taking it very seriously or not. I mean, 10,200, a very high volume, shortening lead, like we're compressing the lead times. It really feels like they're just trying to push a bunch of freight off the coast, get room for some of this warehousing as inventories are just getting crammed full. Looking at the business to sales inventory ratios, they're off the charts right now. So again, a lot of warehouse repositioning going on right now that I'm just not sure if that's going to be sustainable into the summer months.
Zach, you mentioned sustainability and port activities. We had Lorianne LaRocco on Tuesday on the coronavirus freight market update, and she was talking about consumer demand, especially from China, and how that is very tempered right now. Does that follow along with your narrative on sustained activity at the ports?
Yeah, absolutely. I think what we're seeing is some sort of buildup of, the orders that were made back in March hitting the port all at once. Again, maybe some level of forethought by some of these shippers trying to get ahead to just make sure that they have inventory in this country, knowing that they're going to see decreasing capacity on the maritime side. They've already seen the decreasing capacity on the air cargo side, so they know they don't have access to the short service windows that they had before coronavirus, really came to light. So I think we're seeing a combination of two things. One was the leftover orders that they had, and now they're just basically trying to, one, replenish their stock in their warehouses, and also make sure that they do have inventory available when that demand starts to come online, which has not necessarily materialized yet, so they don't have a lot of room in the warehouses left after this surge of freight has hit the West Coast.
Yeah, one last point to that, and I think it supports exactly what you're thinking. I'm in total agreement with you. Is if you look at the growth, the OTVI, right, mm-hmm. and you break it down by length of haul, Zach, we're now seeing the long tweener medium are the hauls that are or the lengths of hauls that are growing. Rapidly, I guess, but they're the ones that are ticking up, and we're seeing short and local dipping. They're actually going down. So that would indicate movement from DC to DC and not necessarily out of the DCs, right? Or to delivery demand.
Yeah, no, the long haul volumes are important to watch because those are the replenishment orders.
Right.
The short haul ones tend to be the more DC to store freight or some sort of DC to DC movement, which. Again, a lot of what we're seeing right now is probably a lot of that long-haul freight coming off of the Los Angeles, going into these warehouses, and they're just stocking the warehouses right now, mm-hmm. which, again, is not accurately representing demand side right now for a lot of these commodities.
Right. So the origins that are growing and the lengths of haul would support this I guess theory right now, right?
Yeah, because if you look back to March, short haul volumes drove the majority of that freight movement. Right now, we're seeing a lot of long haul freight movement. And just a few weeks ago, though, we did see a slight uptick in shorter haul freight volumes, which we thought, okay, maybe demand is starting to pick back up, but they've kind of tapered off here in the last week or so.
Right. Just goes to, Kevin, you need to be looking at a bunch of different data sets.
Yes. The more data sets you have, the better off you are.
Yeah. And you need people to interpret it like Zach.
Yeah, definitely. Thank you very much,
Thanks,
Zach. Sorry, Director of Freight Market Intelligence here at FreightWaves. And coming up in just a second is Anthony Smith, because we have the jobs number every Thursday morning. We have initial jobless claims, which have been hugely bad news, and it's still bad news, but not as bad week on week. Isn't that right, Anthony Smith?
That's right, Kevin. Still bad news, not as bad news. But as you mentioned, we got the initial jobless claims for this most recent week for coming in Thursday morning. So we saw that there was some 2.3 million individuals that have claimed for jobless benefits here. And when we're looking at this brings the total up to somewhere around an estimate of 39 million Americans that have claimed over the last 9 weeks. Now, the thing to take in mind with this number is that these are Americans that have made these claims. They have not all received benefits. These are the claims that have come in so far. And knowing this overwhelming amount of claims that have come in, this tells us that these states, of course, are going to be and are being overwhelmed with a number of claims and issuings coming through that are really kind of causing a backlog as many states continue to work through this.
Right. So, Anthony, that 2.3 million, as described by Kevin Hill, I'd use a little bit more colorful language, but I won't.
Sure.
Less bad, or less hugely bad, I guess.
Yes.
Whatever, however you want to say it. So what is that trend line, right? Because we were like at 7 million and 5, then 3 or 2.7. What has been that trend line? Is it a steep drop, or is it kind of flattening now? Kind of hanging at the 2.3, 2.7?
Right, so when we're looking at this, it is less bad, as Kevin put it, and there is a noticeable decline, and it's been a pretty consistent decline here, but it's still very, very high. One of the things we're going to be looking, as I always like to look at, is the continuing claims, and that's something that we're going to be watching closely in the next coming weeks, because this is going to be, I think, the sure shot sign of a recovery setting in. Now, when we're looking at most indices on the macroeconomic level, April has really been seen as really the trough for many industries, and really with the expectations of this leading to unemployment hitting levels somewhere near that 20% mark potentially, and really expecting that to be the worst of the worst when we're looking at these unemployment levels. Of course, these are huge numbers that we haven't seen in decades, if not ever, when we're looking at the magnitude of how quickly these have really kind of overtaken many Americans. But the recovery side of it all is going to be very interesting, as well as many states are now starting to reopen again. And when we're looking at these reopenings, that's going to start to hopefully alleviate some of these jobless claims that are coming in as some Americans get back to work. If they are not swayed too strongly by some of these incentives right now that are in play, because of course that additional $600 for many Americans really is bringing up their take home higher than what they would be if they were in the workforce right now.
That's a solid point, Andrew. Or, Anthony, sorry.
Yes, it is a solid point. How about other data points that are out there, like manufacturing data? How is that looking for a jobs recovery?
Sure. So as we know, manufacturing going to be and has been one of the hardest hit. There were overhang effects from 2019. We're looking at tariff wars, trade uncertainties, a lot of uncertainty within industrial production, manufacturing, a lot of uncertainties. We're looking at capital goods expenditures. That has not subsided at all. If anything, has been exacerbated by the current pandemic. And so when we're looking at manufacturing, they have the Philly Fed Index, which just came out. I think Mike, Vincent, and I will be chatting about that a little bit later here before the week is over. And we also have the Empire State Index. And so these are regional Fed indices that show what the sentiment is within that localized region. And what we see there, Kevin, as you mentioned earlier, it's bad but less bad. So we're seeing some improvements from the negative 50s of improvement of 13 points plus. So they're still below that zero mark and well in contraction, but things are starting to slowly improve there on that front, on these small regional levels.
Yeah, so the sentiment is improving, and as we look to that, you would expect the continued drop in jobless claims, and so the continued jobless claims as well is as you mentioned, is a strong indicator of whether we're recovering or not. Excluding the factor that you said that many are actually better benefits and more pay actually not working. But if you get them to work, these should be coming down. When does continued or the sustained or continued claims? When does that number come out? Isn't it? It's every 2 weeks? Is that right? Or when do we see that?
Sure. So when we're looking at continued claims, it comes out actually the same day as a jobless claim. So it's released by the same department, but it's not as exciting a number for many individuals because, as you mentioned, it has that 2-week lag. So
right.
Jobless claims is looking at the most recent week, while continued claims looking at 2 weeks ago. So it's a little bit of a lag there, and I'm hoping that now as we're seeing that economies start to come back online, that number should be coming down in the coming weeks. As I mentioned, there is that strong incentive, and so many Americans are able to return back to the workforce early or now, so to speak, in a safe, social distance, responsible way, are probably going to be at an advantage in the coming months compared to those that are maybe writing this out to try to get the most bang for their buck, if you will, for these jobless claims, because as we all know, the economy is not going to just jumpstart with many industries just coming back online at full force. There's going to be a buildup, and so those that are getting into the workforce earlier on are going to be securing themselves a little bit better placement, because these jobless claims added benefits are going to expire in the last week of July. So come August, they're going to be up for potential expansion for more bonus benefits, but it's yet to be seen if that's on the table just yet. and if it will still be for that same $600 mark. So there are a lot of things at play here for many Americans as they look to return to the workforce, some looking to be a little bit more strategic, but I do think that those who are getting back into the workforce sooner rather than later will be putting themselves in a better position, especially when we're getting to this, the fall and winter months.
Anthony, we're rolling into Memorial Day, the weekend, big holiday. Is there anything, so it's basically rolling into the measuring spending compared to maybe last year. How significant would that be? You know, how important is Memorial Day spending this year to forecast maybe where we are in a recovery, or if that has any bearing on it at all?
Well, when we're looking at Memorial Day, of course, it's one of those busy holidays. I'm sure you've probably had your email inboxes loaded up with Memorial Day specials on any kind of businesses that are opened up for e-commerce, trying to drum up that business. So there is that aspect of it. One of the things I will be looking forward, not just Memorial Day, but other holidays that have really kind of ramped up. Remember Christmas in July, all of these other e-commerce holidays that are really kind of coming up into really having prominence in the marketplace. I'll be looking to those holidays as well, a little bit more so than this upcoming Memorial Day holiday. But this, again, is an opportunity for those businesses that are looking to transition and pivot a little bit more to take advantage of those e-commerce sales and really kind of expand their grasp on these potential consumers that are really ramping up their buying habits online. As we saw in the last edition of Retail Sales, non-store retail sales has been one of the only or few components of retail sales besides grocery store retail sales to have a positive or any kind of growth on a year-over-year and month-to-month basis.
Yeah, that's a good point. That's your single positive, right? When when you're looking at imports, et cetera, every industry in imports is down. There was a little bit of an uptick day over day earlier this week in the imports across many different industries, but it quickly dropped off, and week over week is terrible. And as far as the imports, business to business, it's production, et cetera.
It is. Anthony, I have another question for you. Your favorite question, your favorite sector and industry, housing. How's housing going right now?
So housing definitely had a rough month in this most recent release, and it's kind of disheartening. When you're looking at housing construction, spring is usually the busy month. We see a lot of builders start to come online. It's really, really kind of unfortunate with the timing here, but there are expectations of recovery here. So we're looking at the home builder sentiment that actually increased from last month. So builders are starting to kind of have a little bit more optimism. Of course, it's going to be different from region to region. So of course, when we're looking at the Northeast, that's going to be a little bit more skewed. Of course, there's even seasonality skews in there. When we're looking at the Northeast, it's going to be a little bit later in the building season with adverse weather. Of course, we're looking at the type of housing projects there. There's going to be more multifamily than single family. South definitely got hit, but not as hard as some of the other regions, and is the most substantial or largest region when it comes to housing starts. And an area that I think is still a lot of optimism when we're looking at recovery efforts. Looks like the South is one of, especially the Southeast, has been one of the areas that have really been proactive on leading a charge. West Coast definitely got hit hard, and of course the Midwest. But we're looking at overall housing. There is still a lot of optimism in the latter half of the year, potentially, especially when we look at the summer months. The supply chain did get a few disruptions, of course, when we're looking at the outcome from COVID-19, of course. But when we're looking at that demand, it's still there. Inventory was very tight. It's just going to come down to consumers being in a position to make these purchases. Of course, we're looking at the home purchasing sentiment index that, of course, is moving down. People are feeling uncertain about making these big ticket purchases just yet, even though some of the smaller ticket items are a little bit more appropriate for them right now.
Thank you very much for those economic insights, Anthony Smith.
Thank you, Anthony.
And next up on the program, we are joined by joined via Skype by Marilyn Surber at Tenstreet. Marilyn, are you there?
I am here.
Oh, very good. How are you doing today?
I'm doing great. You caught me in the action of having Wi-Fi issues, which is a sign of the times that we're living in. So it's a perfect example to kind of roll into what we're talking about on the show today, right? So.
Yeah, that's exactly that's a perfect lead in. So driving schools. Most of them went online or offline, had to close down for a while. What's the process? What's the situation with driving schools right now?
Okay. Yeah. So we had, depending on where driving schools were located, we did see a lot of them shutting down, or at the very least kind of reducing the number of drivers that they were able to train if they were able to stay open. It was very state based on the state that they were in and what the DMVs were doing there. Now all the DMVs, besides we think about 5, have opened up with at least limited capacity, but that's the key phrase, right, is limited capacity. So now what you're starting to see is, schools are opening back up and they're starting to try to ramp up training again, but they will not be able to train as many people as they have been training really for the foreseeable future until we move away from, social distancing and masks and, all the other things we've been talking about that deeply impacts drivers' training, because usually you would have 4 or 5 drivers in a truck, training at one time. You can no longer do that. You also will start to see, the DMVs are open, but there's some, the testing is limited still, and some aren't doing testing at all. So you have a huge backlog of students who had their permits already and had completed training before this happened that now are still don't have their CDL. So that doesn't even take into account the ongoing folks who are graduating as we continue training, and how do we get them tested and get back online. So it's a big issue. Obviously, right now we're working closely with CVTA and the National Association of Publicly Funded Truck Driving Schools to see what those best practices are going to look like for schools and how they're going to be able to ramp back up that capacity so that it doesn't impact carriers as they ramp back up their hiring as well.
So how has it impacted carriers so far? Because that's a large candidate pool, new recruits coming out of truck driving schools. How have carriers and fleets adapted to that?
So I think there's some good news, and part of that good news is we haven't really seen driver hiring overall in the macro aspect take a huge dive. We have seen it, it's been down at a high of looks like about almost 27% down, but that was at its lowest point, but you now see it starting to come back up. It kind of happens in lockstep, if you will. And so as carriers are hiring less, that also means they're hiring less students. So some of that did work itself out just kind of organically because of the market. But as carriers do ramp back up, student hiring was down more. It was down 35% at its high. And so as schools are only able to train half, essentially, of what they were, when you have carriers in the next 3 to 6 months, hopefully, back to hiring at full capacity, we stand to see a huge downstream impact of where these drivers are going to come from. Also keeping in mind, when you hire an experienced driver, you can put them in a truck and they can start hauling freight after they complete orientation. It takes, 4 to 8 weeks, sometimes 12 weeks even, to get a student driver in their own truck, being productive for a company.
Yeah, I was going to ask you that about, I guess, upstream in the driver supply chain, because when we're talking about it at the company level and whether they're hiring or not, what were the effects of student demand for training, new students coming in? Did that drop off during the crisis, or was there an influx of that demand? And what do you see moving forward? As industry ramps up and some of them fail, will there be more people looking for this? Are they recruiting? You think it's going to fail and they're going to have to try and recruit more strongly, even if they do ramp up the schools? Will there be a shortage, or what's your thoughts?
I think those are great questions. I think one of the positive things that has come out of this is a lot of great press for the trucking industry and well-deserved attention for truck drivers. And so we have seen plenty of interest still, talking to schools out there. People still want to come to truck driving school, and they still want to be truck drivers, and there's still, funding for truck driver training. And so I think people want to do it still, and I think it will continue to be kind of the lifeblood of our economy and an in-demand occupation. And we'll just have to figure out how we're going to do it in these new times that we live in. There's a lot of online training going on, and companies are starting to adapt. Schools are starting to adapt and, put those best practices in place. But it's going to take extra effort for sure to get those people recruited, hired, trained, and then, at work at a trucking company. And there's also some questions is, where will some of those jobs shift, right? Will they maybe be doing more delivery drivers, than there were before, because we see online sales are up so much versus, some other types of freight. So there might be some shifting in where those workers are going, if you will.
Yeah, that makes sense.
Yeah, it makes perfect sense. Thank you very much, Marilyn, for your time today. How do people reach out and contact you?
So they can contact me on LinkedIn, Marilyn Surber, or they can email me at marilyn.surber@tenstreet.com. Any way they can get a hold of me. Skype me, right, Kevin, or Snap.
I know, right?
However you want to get a hold of us, we are there. So also sales@tenstreet.com.
Thank you again, Marilyn, for your time today.
Thank you, Marilyn.
Thanks. Bye-bye.
Bye-bye. Always great insights on driver recruiting and in the pool of qualified candidates. It's a huge expense for trucking companies and fleets. And
it is.
It's
I was
usually
behind two student drivers twice, last night going home and the night before.
Very good.
So there you go.
There you go.
Students
they're still training.
It's up by 2 people.
Up by 2 people, definitely.
Important topic, though. Very important.
It is a very important facet of the business. It's usually one of the largest internal divisions of trucking companies are the recruiting departments.
Oh,
and
yeah.
It's amazing how much they spend on human talent, sales to recruit, and then digital advertising, and their marketing budgets are huge, probably larger than the marketing budget of the actual services.
And that's a high pressure type of position as driver recruiter in these major carriers. It's incredibly important. It's interesting, and it's I loved hearing her perspective of what was going on with these schools, right? Because you're not sure if the schools, lack of drivers, the schools are shutting down. Is it because nobody's wanting to drive, or it was mainly safety precautions? Right? And the DMV, and those schools were under lockdown as well. Right, so
they still partially are in a lot of areas.
Yeah, and it'll be very interesting to see what is the demand for those schools by new students as we move forward.
It will be
right.
It will be.
So
yeah, and I think our next guest is ready via Skype. And
not Snap this time?
No, Skype. I got it right this time. Awesome. So Alan Adler, I think he's right here with us. He's the bureau chief here at FreightWaves for Detroit and covers a lot of OEMs and truck stops and auto manufacturing. How are you doing today, Alan?
I'm good, Kevin. Thank you. Do you really want to see the mask or not?
The mask?
If you do, I have.
No, that's okay. There we go. Great.
Are you guys doing okay?
We were doing great here.
Great, Alan. Nice to have you on here.
Yeah, very, very good to have you on here. And you came out with an article yesterday on FreightWaves.com on new Class 8 truck orders. What's the prognosis?
Well, it's not good, obviously. We've gone now April and May with practically no trucks being built. What that's causing, of course, is not just a stop up in production, but it's creating havoc within the backlog. And the backlog, of course, is that 12 months of unbuilt trucks. What we're seeing now is that at least if you back out the 10,000 units that fell out from one manufacturer in April, you effectively had a negative build. You had about 6,000 negative in terms of the number of trucks built. Now, some of those could come back over the next 12 months. They were not canceled officially, but they were delayed in such a way that they fell outside that 12-month window that counts as backlog.
So you have 2018, which was a historic year, broke the record for new truck orders. 2019 was far below average.
2019 was a record for production, 345,000 Class 8 trucks. That's enormous. You're looking this year. ACT Research can't change its estimates fast enough. They've made several. They say actually 5 downgrades just in recent times, and they're down to 117,000 for this year.
So, Alan, is the supply chain for these OEMs trying to manufacture exacerbating the problem? I mean, in the article you talked about how Daimler May production basically did not happen because they couldn't get the Mexican counterparts up because of the government and the shutdown, and they're kind of lagged from the recovery of COVID.
Well, you've got, Michael, you've got two things going on there. First of all, is COVID has not really hit the curve downward in Mexico yet, so they have health issues. The other thing for Daimler, of course, was some supply chain backup and congestion and problems there. So they tried to come up in May and couldn't do it, and they're shooting for June 1st right now. The thought being that when they start, they'll start very slowly. Those that have started, we saw it with the car plants, they're bringing people back very slowly, a lot of distance and that sort of thing.
So on new production, what's the forecast for 2020 as of right now? On new orders and production.
Yeah, so the new orders number about 117,000 right now. The retail sales number, which would be closely related to the production number, about 158,000. That's less than half of last year, almost more like 40% of last year. And we were already expecting lower numbers because we had, like you mentioned, Kevin, 2018 and 2019 were so high that you already were expecting a 30% number downward. But now with COVID added to that, it's closer to 45%. 2021, you didn't ask, but I'll volunteer it.
Sure.
Production, roughly 191,000 because you're going to get so many orders that are getting pushed out farther, from April to August and beyond.
So in that article, it was quoted William Rush, right? CEO of Rush Enterprises, right? One of the largest, if not the largest, retailer of Class 8s. Is that right?
That's correct. Yeah.
He was saying He was seeing a slight uptick in demand. Is that right?
Yes, and you're going to start to see that as you get into June. He has seen he does a lot of tracking, data tracking of miles of trucks that are on the road and that sort of thing. So he can tell that more miles are being driven. He's seeing these could be a blip. I mean, he also says in that yesterday that a week does not a trend make, and so he's not real sure. I think his greatest warning, Michael, that came out of that discussion was that look out if we have a second wave of coronavirus, because the people are being carried, the banks are carrying people, deferred payments and so forth right now. You can recover from that once, but you probably can't take a second hit.
Yeah, that's what I got out of that as well. I was going to bring that up, and he was also not implying that even without that second wave, there's people that are stretching the limits right now and could falter regardless, even during the recovery, right?
Yes, absolutely. And I think, one of the things that was discussed when trailer numbers came out recently, which were also horrible, and they tend to track tractor orders. But, FTR's out this morning with a number of 230, literally, trailers being ordered in April, which is nothing. That's like, why bother?
230?
But one of the questions that came up on the call with Wabash National earnings call last week was, when do you expect to start seeing some shakeouts, some consolidations, things like that? Those are coming. Clearly, they're going to happen, obviously, across the freight industry. But trailers, you've got 25 trailer makers, according to our Mike Bondestol, and about 8 of those are big guys. They're not all going to make it.
No, not with 230 orders in a month. It's going to be tough, isn't it? How about the used equipment, Class A and trailer markets? How are those trending right now, Alan?
Not good. Everything sort of rolls downhill, right? And you've had, first of all, we have just too many trucks of all kinds, right? You've got a glut and an incredibly depressed pricing on used trucks right now. You've got too many of them still out there. One of the good things that Kenny Veith from ACT mentioned to me, we talked yesterday. He said, one of the bright spots of this doesn't relate directly to your used question, but he said, because we didn't build any trucks in April, we took 11,900 units out of inventory. So you've got a big inventory overhang now anyway, but it's a little less than it was. It'll be a little less after May as well, because, again, not much production of new trucks. On the used side, though, the prices are to the point now where, people looking for good deals, especially on 5- and 6-year-old, 7-year-old trucks, are getting great deals. It'll be interesting to see what happens with the newer trucks that have the automatic transmissions and some of the safety equipment, how those prices hold up.
Very interesting. Very interesting.
It is interesting. It's just a really bear market out there for the OEMs.
Yeah,
definitely. How are the travel plazas and truck stops holding up through all this, Alan?
Well, that's interesting. Yesterday, it was interesting that TA, again, we can get more information, obviously, from the public companies than we can from the privates. Pilot and Loves tell us what they want and when they want, but TA is more subjected to what the Securities and Exchange Commission tells them to do. So yesterday, they came out with a release that says they're pushing franchising. And of course, we knew that. We had an opportunity to talk to John Perchik a couple of months ago, the CEO there, and he said this was a big push for them. So the franchising is sort of what they're looking at in terms of growing their dots in the map, if you will. They still trail Pilot and Loves dramatically in terms of outlets and places to go. But it's interesting that as the growth happens, it's again sort of a consolidation, because the people being pushed out are the independents. They're the ones that are probably going to be the targets of a TA or a Loves or people like that. That's who's going to take over these places. So you're going to see some of these, if you want to call them mom and pop shops, go away and maybe become rebranded as one of the big three. They are staying open. Showers are open. But again, TA said last month they're starting to reopen restaurants where they're allowed to. But they also laid off 3,000 people. So it's a difficult time for them. We don't really know what's happened. I think Love said in conjunction with opening new outlets that they're adding 2,000 or 2,500 people. But it's really hard to know. But these jobs, a lot of them, especially in the restaurants, they're gone for good.
Exactly. I think you're probably right, Alan, on that point. You can find all of Alan's articles on FreightWaves.com. Thanks again for your time today, Alan, and phenomenal picture right behind you, just as you described.
Thank you. Thanks. Have a great day, guys.
Thank you, Alan.
Thank you, Alan.
So with all that horrible news in the OEM and Class A, let's turn to some good news, right, Michael Vincent?
What'd you say?
Change the direction. Great.
Yeah, change the direction.
That. So definitely. FreightWaves.com in the today's pickup, Full Bay Cares launches to help support those in need. So, right, the company said it expects Full Bay Cares to continue even after the pandemic subsides, and it will look for ways to contribute positively for those in the heavy-duty repair community. So throughout May, every time a U.S.-based shop signs up with Full Bay Cares will make a donation to Feeding America. For each Canadian based shop that signs up, Full Bay will contribute to Food Banks Canada. Both hunger relief organizations stocks hundreds of food banks across North America, helping to feed hungry families and raise raise awareness. Jacob Findley, CEO and co-founder of Fullbay, sees Fullbay Cares as an opportunity to support the community in a time of need. Feed America is the biggest hunger relief organization in the United States, stocking over 60,000 food pantries and 200 food banks across the nation. Food Banks Canada operates a network of over 500 food banks and 10 provincial associations. Good stuff.
It is good stuff. And every, twice a week we're on this show and we're always sharing people giving back during this time of crisis. And it's really good to see.
It is really good to see. And as I always say, I hope this is one of the things that sticks after this, because it's really good to see. We don't need a crisis like this to care about each other and help each other out. Let's continue to do it. I'd really like to see that.
What
do we got coming up on FreightWaves TV there, Kevin?
This afternoon we have Michael Vincent at 4 p.m.
Me?
You, yes.
Yeah, we do. So,
freight forecasting.
Yeah, freight forecasting. So Anthony Smith, our lead economist, who was on with us just a few short moments ago, will be back on with me, and we'll be looking at the different macroeconomic indicators, looking at what's going on in volumes right now, in trucking volumes, and really looking at those long-term indicators, short-term indicators, et cetera, because as you know, it's extremely difficult to use seasonality or historic trends to figure out what's going on right now. And as Zach Strickland, director of Freight Intelligence, pointed out, the numbers aren't acting the way they normally do. They're not jiving with each other in the way they normally would before, like a Memorial Day weekend. And so you need real-time data and some of those points. You
do. I mean, nothing in the economy you could predict with historical data right now. We just heard 23 trailer orders. Or
230.
230. Yeah, sorry, 230. It was even more negative.
Which isn't a whole lot better.
About 23 or 24 manufacturers, right?
Yes.
And you had 240 trailer orders, so there's no way to historically predict that. This is a black swan event.
There really isn't.
Same with forecasting.
Yeah, and then tomorrow on
What the Truck at
so
12 p.m. Eastern Time.
We had an epic, then an epic-er.
Is this going to be the epic?
This one's hugely. Or epicest.
Epicest.
Yeah, the epicest. So Doug Potvin, CFO at Trinity Logistics, Mark Vickers, CEO of Boardless Coverage, Ken Sherman, VP and General Manager at IntelliTrans will be on talking. I'm looking forward to the IntelliTrans. They track way up supply chain.
They do. Yeah, we had him on 2 or 3 weeks ago on this show, and
things were horrible. He had the
raw materials.
It was really 3-4 weeks ago, and they had we were seeing the downtick, right? Already been in the downtick in freight volumes for a few weeks. And he said it had just hit his end of things, which is way upstream. If it comes out of the ground, they're tracking it.
That they are, and I'm definitely tuning in tomorrow to What the Truck to hear Ken and see what data that he has right now.
Right.
So that's on Friday. Yesterday, you can find this on FreightWaves TV as well as all of our programs and podcasts as well. The Freightcast on Apple Podcasts, Spotify, wherever you download your podcast. But we did put that coffee down. Dooner and I interviewed Trent Broberg from truckstop.com, and we talked about returning to normal, returning from work to home, getting the office back. Really gauging the new normal that we have, business etiquette, about in-person sales.
I cannot
emphasize this enough.
Is that why Alan had the mask on?
Yeah, it is.
I think he's taking your advice, and it is incredibly good advice.
If you go to a company and you enter their offices, and you're a salesperson, you should always be wearing a mask because you don't know what the policies are. And a lot of shippers are heavy industries, food processing, that type of warehousing, so they have pretty strict policies themselves. So always, we talk a lot about face masks and kind of just etiquette and video calls and how we're going to get back to new normal.
Yeah, you can look at a whole bunch of stuff. Great quarter, guys?
Great quarter, guys, as well. We talked about roaring out of a recession and what companies do. The different strategies and who, coming out of a recession, who handles that the strongest.
Yeah.
Who performs the strongest?
Who performs the strongest?
Who performs the strongest?
And it kind of links into what you were in Put That Coffee Down, doesn't it not?
It does,
I mean,
yeah.
your sales guys help you be strong, right?
It does.
And it's that etiquette. And you gave away, what was the book?
It was How to Be a Rainmaker.
How to Be a Rainmaker.
Yes.
And that is key, is knowing your audience, right? And having that proper etiquette. And as an organization, being the problem solver.
Being the problem solver.
And understanding the issues that your that your customers have, and going that long sale. Especially in this time right now.
Definitely. And then we also have, you can also tune into Freightonomics and with SONAR, and those were Wednesday as well, but that wraps it up for this episode of Coronavirus Freight Market Update.